Coming up, Qantas revamps its loyalties business, Chinese investment falls in Australia, and gold hits another record. That is all next. It's your daily 10-minute business and finance news wrap for this Monday, the 8th of April, 2024. The Australian share market rose today, up by 0.2%. We'll get the details with Alex Pikoulas from Harper Bernays, and later, Han Hendrischke from the University of Sydney will give us the details about Chinese investment in Australia falling and why that's important. But first, to Qantas, which is investing $120 million, improving its frequent flyer program. It's introducing a new point tier called Classic Plus, adding 20 million of these reward seats. It basically means members get a greater chance to redeem points for flights, but generally need more points than the base Classic tier, where there are about 5 million of these reward seats. So will all of this improve customer satisfaction? For more, I spoke with Angus Hewitt, an equities analyst at Morningstar. Angus, a $120 million investment from Qantas into its frequent flyer loyalty business. How significant is this for the airline?
It's about 5% of last year's pre-tax profit. So as a one-off, it's fairly immaterial. But more importantly, it's not new investment. It's part of the customer experience investments that were previously flagged since last year's earnings. The bigger question from a share price point of view is whether it actually works, whether redeeming points, which is now going to be easier, will the customer respond in kind?
It is, however, expecting lower full-year earnings as a result. So will this translate to profit in time?
Yeah, it is a little bit lower at the top end of where they were previously guiding for this year. But notably, the long-term target for profitability in the loyalty segment is unchanged at 800 to $1 billion in earnings. In short, loyalty is now a better product. It comes at a cost to Qantas as points are redeemed at less favourable rates. But we think this will be largely offset by improved long-term strength in the program in its new form, which is obviously what Qantas are expecting as well, given the long-term target is unchanged.
So to what extent do you think Qantas has now been listening to its stakeholders, and its brand and reputation, is that improving as a result?
Yeah, they have been listening, and they've had to. Constrained capacity, excess demand in the last year or so meant that Qantas didn't really have to work hard to win business. But now capacity is returning globally, competition is returning to the skies, and Qantas now has to compete to win the customer, regardless of reputation damage seen through the last year or so.
That's Angus Hewitt from Morningstar. In a moment, Qantas share price reaction.
Now, Market Day on the SBS On the Money podcast.
The Australian share market rose today. The S&P ASX 200 up 0.2% to 7,789. The Qantas share price up 4.8%. So investors liking that news about the revamp to its frequent flyer loyalty business. I started asking Alex Pikoulas from Harper Bernays a bit about those Qantas changes first. So, Alex, Qantas is spending $120 million to revamp its loyalty business, but as a result, its loyalty business has issued, I guess, a profit warning, but shares have gone through the roof at Qantas. Why?
Yeah, Ricardo, so the stock's up 5%. There was a profit warning issued. The previous guidance was that loyalty would do underlying EBIT of 500 to 550 million, and that's now been brought down to 500 to 525. So it's a fairly small downgrade, but importantly, they had previously said the 500 to 550 was excluding a loyalty announcement that was still to come. So people knew that there was a change coming to that number, and I think the change has been less than what they had feared. So I think that's the key first thing. But the second and important thing is that they've said that there's 120 million of investment in FY25, but notwithstanding that investment, the EBIT, underlying EBIT, is expected to increase in FY25 for loyalty by 10%. So I think that really displays their confidence in the loyalty business going forward, notwithstanding the investment that they're making here. So I think that's really what the market has taken positively.
Do you think it'll be enough to improve its brand and reputation?
Look, I do think this goes a long way. They clearly have a huge focus on improving their brand and reputation in the market. And you look through their presentations, and it's the first and foremost thing you see in all their presentations at the moment. And they say thank you for bearing with us as we do that. So they're very, very focused on it. And I do think that this Classic Plus flight rewards, which is what they've announced today, does go a long way to giving their frequent flyers a lot more flexibility and a lot more options to spend their points. And that's what people value. People do value the Qantas brand highly, but being able to spend your points has been a key bugbear of their frequent flyers. And this program is going to have 20 million seats available to spend your points on, whereas the Classic Rewards program previously had only 5 million. So there's a huge expansion in the options available for people to get seats using their points.
Okay, let's turn our attention now to the broader market. The ASX is up today. Why?
Oh, look, the key thing driving the broader market higher is strong economic data. And we've actually seen that driving the market higher for a little while now, a few months. On Friday night in the US, there was very strong non-farm payroll data. It came in at 303,000 jobs being created in the month versus only 214,000 expected. So strong data. I think the important thing, though, was that wages data, which was also announced, wasn't high. So the wage growth only came in as expected. So despite the fact that jobs are really strong in the US, you're not getting this concern around, does that mean that inflation's going to rear its head again because the wage data is staying under control?
So if wages are staying under control or relatively under control, but we're still getting strong economic data, what does that say about the direction for future interest rates? Because there's this discussion that interest rate cuts could come a bit later than expected.
Yeah, look, it's a great question. I mean, the market has been expecting quite a lot of interest rate cuts, particularly in the US this year, and the expectation for those cuts has been reducing, and it reduced again on Friday night on the back of this data. So at the moment, what you've now got priced into the market is that the US will have their first cut by around mid-year, and that by the end of the year, there'll be almost 3 interest rate cuts that the Federal Reserve will have done. That has pulled back from a number of months ago where there were 6 interest rate cuts this year expected. In Australia, we've got 1 cut being priced into the market by sort of September, November. And again, that timeline has been getting pushed out. And we've got about 1.5 cuts being priced in by the end of this year.
Okay, spot gold again at a record high. Run us through why we're seeing this strong gold price at the moment, and is there still more to go?
Yeah, look, it's a fascinating one. It is slightly puzzling because if you look at the gold ETF holdings, they've actually been reducing. So it's not private buyers of gold ETFs that are driving the price higher. I think the key driver here is central bank buying and probably a little bit of inflation, hedging sort of concerns. But central bank buying is the key one. China the Chinese central bank have just bought gold reserves for the 17th straight month in March. And the Reserve Bank of India is also buying. I think what you're seeing that central banks around the world doing, there are others other than those two, is diversify some of their reserves away from US dollars, and gold is the beneficiary of that. I think there could be some more of that to come.
Okay, finally, any other companies you're following today?
Ricardo, there are a few announcements out today. So quickly, Elders have had a profit warning today. They're seeing subdued client sentiment off the back of the El Nino declaration that the Bureau of Meteorology had previously given. Life 360 has had an update that's far ahead of expectations, and that stock's performing very strongly today. Monthly active users for Life 360 around 4% ahead of expectations at 66.4 million. And that's through international expansion, which people are very positive towards. Beach Petroleum, they've had a warning today. They've got problems with their Waitsia gas project development in the Perth Basin. First gas for that project has been pushed back. Was meant to be towards the middle of this year. Now it's going to be early 2025. and they've had a 30% CapEx increase, which means an extra $150 million for Beach. And then the last one is Ansell. Ansell are acquiring Kimberly-Clark's personal protective equipment business for around $640 million, which is Aussie about $1 billion. That's to be funded roughly 50-50 debt and equity. So they are doing an equity raising for that acquisition. I think it's a pretty good fit. About 57% of the acquired revenue is from gloves, so there's great overlap there with Ansell, and the business they're acquiring has significantly higher EBIT margins than Ansell does. So I think that stock will probably respond positively to that acquisition when it reopens.
And finally, very quickly, opportunities for investors right now. Where are they?
Ricardo, look, equity markets have run strongly recently. So we are starting to take some profits from some of those winners where we're seeing less value left in them. And we're looking for good companies that have been left behind in this rally. That's the first area. And the second area that we're still very, very positive on is fixed income. With interest rates being higher and looking like they may stay higher for longer, fixed income investments are offering fantastic value at the moment.
It's Alex Pikoulas there from Harper Bernays. From the markets, let's go to China's relationship with Australia. And Australia's improving relations with China will be key to rebuild investment into the country. A new report by KPMG and the University of Sydney showed Chinese overseas direct investment into Australia fell 36% last year to just under $900 million US. That's about 1.34 billion Aussie, and the second lowest year in investment value since 2006. Since 2006 through to 2023, the biggest share by industry was mining and commercial real estate. So how do you improve it? I spoke with Han Hendrischke from the University of Sydney. Han, so Chinese investment in Australia fell dramatically last year. Why?
Well, we have to see that Chinese investment has been very low for quite a number of years. So what we see at the moment is a fluctuation at a rather low level, where individual deals make a difference. We had some very large deals the year before, and without those deals, we get this steep drop now. But in the end, we are very much below the level that we had something like 5 years ago. So we call it a period of contraction. Hopefully, it will be a period of transition where we come from a very high level. At the moment, at the low level with the fluctuations that make kind of big changes at the low percentage. And we hope it will go up in the next future.
But given the pandemic, the way China has been slow to recover from that tense relationship China has with Australia, although it's improving now, isn't that lower investment just expected?
Well, there's reason. That is certainly one factor. Pandemic is a factor that brought it down quite rapidly. But there are other reasons too. There are reasons on the Chinese side. There are reasons on the Australian side. On the Chinese side, they're capital controlled, so they don't allow investment to flow out as they used to until around 2018 or 17. On the Australian side, there are more constraints now in terms of supervision, in terms of screening through the Foreign Investment Review Board. So overall, it's going to be impacted by the political atmosphere improving. That's something that we see already. There are more inquiries, there's more interest. It hasn't simply translated into deals yet.
Why is all of this a problem for Australia, Jen, this low Chinese investment into the country? Why do we need Chinese investment? And what kind of a role does it play in Australia's economy?
That is a great question, because the role of China is actually quite small. China is at the moment roughly the 10th largest investor in Australia, and it sits around 2%, which is somewhere between Netherlands and Switzerland. The big investors are United States, United Kingdom, some Europeans, Belgium are big, and then some East Asian countries. Hong Kong is bigger than China, investment from Hong Kong. So if we add up the two, which we really can't do at the moment, it would still be at a rather low level. So the level as such is not an issue. What is an interesting point, and what is something that we should be concerned about to some degree, is the kind of the disproportion between our trade volume with China and our investment volume with China. In trade, China is by far the biggest trading partner, biggest than the next 4 or 5 together. And in investment, it's really at place 10, so it's fairly low down the range. Now, is that a problem or not? It is a problem in the sense that if we want to maintain the trade volume with China, which means we have to diversify slowly away from iron ore, add new areas, then we would need more cooperation with China, and that would include Chinese investment. So Chinese investment is coming in, of course, in mining and real estate, which are the traditional areas, but it's also coming in technologies, environment technologies, in electric and electrification, electric cars, solar, in the solar energy, and so on. So there's a whole lot of industries where we actually want to have Chinese investment and where we would benefit from Chinese investment. So that's why we keep an eye on that, and that's where Chinese investment is of interest, not really because it changes our economy at the moment, but in terms of maintaining a sustainable relationship, investment plays a role.
You mentioned earlier there were some fund outflows out of China, but still China is investing in other parts of the world. So if they're not investing in Australia, where is all that money going?
No, China is investing in certainly in other parts. Australia is a small part. China is investing in largely 2 broad areas. It's investing in developing countries that would be mainly now Europe, various European countries, in acquiring technologies. That's manufacturing, that's car industries, where China is investing a lot. Smart manufacturing, which is an area where China is moving towards a more dominating position than it had before. All of these are areas where China is investment heavily. It's, on the other hand, moving into areas that are more related to what is of interest to us, and that is namely mining and resources. So China is now, where it was concentrated very much on Australia, is now moving into other countries in the developing world. That could be Latin America, that could be Southeast Asia. And there are some new trends which are of concern to Australia, as China is moving away from pure offtake. That means simply taking raw materials from the mining and take them back to processing in China. China is now starting to bundle mining and processing in other countries. The best example that we had is with the nickel industry, which more or less collapsed at the moment. And that is the result of China investing both in mining as well as in processing in Indonesia. So these are trends that we have to keep an eye on. And we would, in the end, benefit if we had some more cooperation with China in those areas, so that these investments and the result of that doesn't come as a surprise, but comes in a broader form of where we are partners in some areas and maybe competitors in others.
And finally, how does Australia manage this relationship if we want to encourage more Chinese investment into the country? At the same time, we know that Australia is looking to diversify and look to other parts of the world, for example, the ASEAN region.
Well, Australia is doing well. We have to see that the whole geostrategic context has changed since about 2017-18. So we're living in a different world, and everybody's trying to find a new equilibrium and a new way of dealing with the various trading partners. Australia is encouraging Chinese investment more strongly now in cooperation with Australian partners. So we are recommending more joint ventures. The Foreign Investment Review Board is encouraging having minority partnerships for Chinese companies, bringing in Australian joint venture partners. These are areas that have been set for quite some time, and it's part of a learning process for Chinese investors to come here. On the other side, we have more screening than we have before. Some of the screening is happening in coordination with our allies, so that is reducing investment. We have to find a balance in that. I think Australia is doing well by telling the Chinese officially we want investment, and by saying we want it to be targeted in industries that are really crucial for us. So we are doing our best in the overall situation. We have to take into consideration the broader interests of our partners where we are. We have to fit in what Chinese commercial interests are, and we have to fit in our long-term future, by which we want to be in emerging industries, which to quite some extent do come from China.
That is Han Hendrischke from the University of Sydney.
This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial